The year-on-year rate of change of oil is identical to the ISM. All assets are. That everything is the business cycle. The business cycle is everything. So therefore, the oil price is likely, not certain, to follow the ISM lower with a lower economy. To Warren's point, demand gets destroyed. It's the rate of change of demand being destroyed that changes the price. Now, and he's right, is the oil market is in imbalance and will be for some period of time. So that tells us that if we do get a sharper fall out of oil because of the economy and demand destruction, and we know that in 9 months' time, maybe the economy bottoms, well, then we should be expecting to then see more constructive prices. And that's pretty normal. Now, again, people conflate the level of the price of oil with the rate of inflation. $100 oil equals inflation. $100 oil does not equal inflation. $100 oil in a year's time will actually lead to negative 20% year-on-year rate of change of oil because it got to $120. So the question is how far does it go, and in what pace does it go in the future? But I think there's a gap between now, with oil market pricing the ISM at about 54, and the ISM going down to 35. Where does that put the price of oil? Does oil price in the full recession? Probably not, for the reasons Warren says, but it still gives us a risky downside that can catch a lot of people off guard because a lot of people are in oil stocks. If I look down the US sectors, pretty much everything's down 20% year to date, except oil, which is up 25% year to date in terms of equity sectors. So in a recession, you tend to take money off the table. Those kind of sectors get shot. So just be careful. I understand the long-term thesis. I don't disagree with it. I worry about the from here to there.
I'll ask you, if you had new money to deploy for investing today, where would you put it? You mentioned a couple of the things you're looking at, but what do you feel most convicted about?
I'm most convicted on averaging in cryptocurrencies, which I've been buying. I've also been averaging in these growth tech stocks, the ARK type names. I've got a big basket of stuff to reduce risk in some of this, because it's very risky to buy markets that are down, but they're down 75, 80, 85%. And, technology is not going away. The exponential age doesn't go away because prices have gone to the bottom of the logarithmic channel. So, these are 2 to 3 standard deviations oversold. They look very attractive to me, but you need to have a long-term framework, and you need to be able to understand that you may still be wrong by 20, 30%. Who knows? And that not to be an issue because the upside is 10 times that. That's how I think about this. In terms of the trade I like the most here and now that is lower volatility, lower risk is the dollar, bonds. So whether it's TLT or whether it's, whatever flavor of bonds you like. But we've got to get through a recession first before we start talking about the next cycle's inflation. Now, does inflation settle down to 3% or 2.5%? I don't know, but I do a chart of 5-year real rates, and they've been declining for 25 years now, and the trend rate of real rates is about negative 1%. Definitely to do with onshoring. Manufacturing bases, supply lines are changing. I think it's temporarily good for jobs for construction, temporarily good for commodities because you need stuff to build stuff. But if you look at the Tesla factories, and the Amazon factories and the warehouses, the robots are winning. And the robots are very, very deflationary. So, we saw this again after World War II, we had a massive boom, a massive building boom. That building boom actually didn't generate that much inflation in the end. It generated it initially from the supply issues, and then it settled down. What we got was actually decent economic growth. I actually think the backside of this cycle is probably half decent economic growth if this onshoring continues and we get some fiscal stimulus, which I think is needed at a structural level in both Europe and the US. And I think things like ESG, the kind of coalescence of capital around that creates more of a boom because it creates technology, it creates a change of infrastructure. And these are good things. I don't necessarily think they're inflationary. Sure, things like copper could have a real tight spot, but copper, as we've seen, prices in the business cycle first, and copper's been going down like a lead balloon, as